So you've probably seen it blowing up on social media, right? SMC, or smart money concepts. It's this trading theory that's gone completely viral, and for a pretty simple reason. People who follow it believe it's the secret key to really understanding how the markets move. But is it just hype, or is there actually something to it? Well, let's dive in and break down what smart money concepts are really all about.
At the very heart of SMC is a really provocative question. Are the financial markets a level playing field, or is there something else going on behind the curtain that most of us regular traders completely miss?
Here's the core idea. The big institutions, we're talking banks, hedge funds, the smart money, they don't just trade in the market. They actually move it. And when they do, they leave behind what SMC traders call footprints. The theory goes that they don't just participate, sometimes they're setting deliberate traps to take advantage of smaller retail traders. But hold on, this isn't about trying to fight the big players. No way. The entire philosophy of SMC is learning how to spot these footprints and trade with the smart money, not against them. It's all about following their lead. And to follow them, you've got to learn to speak their language. See, SMC has its own unique vocabulary that it uses to describe what's happening on the charts. So let's break down the key terms you absolutely need to know. First up, we have order blocks. Now, think of these as specific zones on your chart where the big institutions are thought to be placing enormous amounts of buy or sell orders. They have to place these orders really carefully so they don't cause a massive sudden price spike. And that careful placement creates a really distinct zone of price action. And take a look at this. It's a perfect example. You can see how the price just kind of hangs out in that order block zone before a huge move down. SMC traders believe this is exactly where those institutions were quietly loading up on their sell orders before pushing the price right off a cliff. Okay, next we have breaker blocks. This is where the theory gets a little more conspiratorial, maybe. It's a potential explanation for why that perfect support level you were watching just suddenly fails. A breaker block is basically a former order block that gets smashed through. And SMC suggests this is sometimes done on purpose to trigger all the stop losses from retail traders. And this chart shows you exactly what I mean. See that support area? The one where everybody probably felt pretty safe buying? Well, it gets completely run over. That safe floor has now been broken, and it's turned into a trap for all the buyers who got in a little too early. You ever seen the price on a chart just rocket up or crash down, leaving this empty space behind? That kind of aggressive, one-sided move is what creates a fair value gap, or an FVG. It's basically an imbalance, and the theory is that the price will often come back to fill that gap later on. Here's a perfect look at one. See that space between the top of that first candle's wick and the bottom of the third one? That's your FVG. It's a sign of really extreme, one-sided buying or selling, and it's a zone that SMC traders watch like a hawk, waiting for the price to come back to it. All right, let's talk about something fundamental, the break of structure, or BOS. This is really just the market giving you a big thumbs up saying, yep, this trend you're watching, it's still going strong. In an uptrend, that means making a new higher high. In a downtrend, it means a new lower low. It's all about confirmation. And this chart shows it happening beautifully in a downtrend. See how each time the price breaks below the previous low, we get a BOS? It's a super clear signal that the sellers are still in charge and that the downward momentum is healthy and just continuing on its way. But what happens when a trend might be running out of gas? So while a boss tells you the trend is continuing, a change of character, or CHOCH, is the exact opposite. It is the very first warning sign that a trend is losing steam and might be about to turn around. Now look at this. This is the critical moment. The market was making lower lows, right? Confirming that downtrend with every BOS. But then, bam! Suddenly it fails to make a new low and instead breaks the previous high. That's your CHOCH. That's the market literally changing its character right in front of you. And finally, we've got to talk about liquidity. Honestly, this is probably the most important concept in all of SMC. Liquidity is basically just pools of money. It's where retail traders tend to place their stop-loss orders or their entry orders, usually just above recent highs and just below recent lows. And this slide shows you where those liquidity zones typically are. See that double bottom? You can bet there's a huge pool of stop losses sitting right below it. That clean trend line? It's full of buy orders. According to SMC theory, these pools of orders are like magnets for the smart money, who might want to push the price there just to trigger them. Okay, that was a lot of theory, I know. So how do you actually use this stuff to find a trade? Let's put all these pieces together and walk through a really simple three-step strategy using these concepts. Step one is the absolute foundation for everything else. What is the market trying to do? On this chart, after a really clear downtrend, we get that powerful change of character, the chach. That's our signal. The game has changed. We immediately stop looking for sells and we start hunting for buys. All right, now for step two. We have to find a high probability entry zone. So after that trend shifted, we can see the price create some liquidity and leaves behind a fair value gap. And what's sitting right below all of that? A nice, clean order block. This is a prime location because SMC theory suggests institutions will use that liquidity as fuel and fill the gap on their way down to enter their own buy orders in that block. And finally, step three, execution. The plan is simple. You place your entry right at the start of that order block, you put your stop loss safely tucked away below it, and what's your target? That recent high that was formed during the trend change. It's a complete trade plan, with your risk and reward clearly defined before you even think about clicking a button.
So you might be thinking, hey, isn't this all just regular price action with fancier names? And you know what? That's a fair question. The key difference is the focus. Traditional price action looks at how the price is moving, things like chart patterns, support, resistance. SMC, on the other hand, tries to understand the why behind those moves, the alleged institutional intent that's driving the price.
But let's be real for a second. SMC has its diehard fans, and it has some very serious critics. On the plus side, it gives you a totally new framework for looking at the market, and a lot of it is built on solid, proven price action principles. But on the downside, there's just no concrete proof of this supposed manipulation. A major criticism is that the pool of retail liquidity is like a drop in the ocean for big institutions, so why would they even care about it? And that brings us to the final big question. Is SMC a truly revolutionary way to see the market, one that reveals the hidden intentions of the big players? Or is it just a really compelling story that cleverly repackages timeless price action principles with a new, kind of complicated vocabulary? The debate is definitely still out there, and ultimately, it's for you to decide.